And welcome everybody to the Summer 23 briefing for the quarterly economic commentary. I'm Dr. Conor O'Toole, and I'm joined by my colleagues Kieran McQuinn and Wendy Dish from the QEC team. We're going to run through this in the usual format. Both myself and Kieran will talk through the key headline findings, give you a flavour for some of the analytical work that we've undertaken as part of the commentary for this particular quarter. And then we'll be happy to take any questions or answer any comments that you may have. So with that, I'll just kick off. Okay, so if you can all throw your minds back to where we were at the previous commentary, there were a number of different elements that were to the forefront of our thoughts there. The basic premise was that the Irish economy had weathered both the COVID-19 storm and the initial outset of the energy shocks from the Russian invasion of Ukraine reasonably well. Certainly there had been a rapid escalation in price levels in both the domestic and international economies that had created particular challenges, but in a sense the domestic economy had continued to operate quite robustly. And over and above that, some of the more pessimistic predictions for the international economy around the turn of the year had appeared to be abating somewhat, in particular with the global trade position, but also with some of the international financial headwinds around the banking distress that had occurred in the first quarter of the year. Some of that had abated. So we were coming into the first commentary of the year with a position that was reasonably robust. So relative to that, where are we now? In a sense, we talk about this a lot relating to the Irish economy, but it really is a tale of two economies that we're talking about again. On the domestic side, the economy is operating very robustly. The labour market in particular is at capacity. It's operating at a historic low levels of unemployment. We are continuing to have very strong consumption activity in terms of household expenditure, even somewhat stronger than we may have predicted at the early part of the year. And again, the public finances are in very good shape. So when we look at the domestic side, we really are experiencing growth rates that are very favourable and are very robust, given both the external factors and when you look across peer economies internationally. Whereas I think when we focus in on the multinational sector, at the previous time we were talking a little bit about the ICT sector, some of the challenges that particular sector was facing, and whether or not there may be ripples through the sector's activity here in Ireland that might be problematic in terms of the economic outcomes here domestically. And if you can also recall some of the work we talked about, how concentrated our exports were. We've talked a lot about the concentration of corporation tax receipts, but on the export side, we're equally concentrated in a small number of sectors. The ICT sector and the pharma sector, they account for a very large share of our overall exports. And what we're actually seeing now, which is counter to what we had expected early in the year, is a slowdown in export activity. And it's coming through in particular the pharmaceutical sector and some other key sectors, which is something we hadn't expected to see. So we do see some weakness coming through that export channel, which is concentrated to the pharmaceutical area. But we do see the ICT sector holding up, in line with expectations. So this is the tale of two economies story. We have the domestic economy, which is growing robustly, and we have some of these international factors slowing down the export trade. In terms of the core shock that was experienced last year, which was the cost of living crisis and the high inflation rates in 21 and into 22 and the first half of 23, we do expect inflation to come down somewhat this year and again next year, but the core inflation rates, so this excludes elements like the energy and some other elements, that is remaining robustly high. And I'm going to talk a little bit more, and Kieran is going to touch on the potential for the tight labour market to feed in through to higher prices, in higher wage expectations, which could risk a re-acceleration of the inflation rate. So to kind of run down quickly through the forecast table, you can see we present both GDP here and MDD as modified domestic demand. Just to clarify the modified domestic demand, so that is an indicator which looks at household expenditure, the government expenditure and investment activity here in the Irish economy, excluding some of the globalized investment categories, in particular aircraft leasing and the intellectual R&D asset category. So it tries to get at a more direct measure of activity that's occurring here in the domestic economy. So for 22, we had an incredibly strong GDP growth rate that was mainly driven by the multinational export activity, but we also had quite a strong modified domestic demand outturn, and that was to do with strong recoveries in investment and also household expenditure, which re-accelerated after the pandemic period. For 2023, you can see we've really revised downwards our GDP growth rate. We're calling a flat change in GDP, and that's basically on the back of our changed expectations for exports, in particular the merchandise exports coming through the pharmaceutical sector. And this is quite a notable downward revision on our previous commentary. For 2023, for modified domestic demand, we are expecting growth to continue robustly, so just under 4% growth, and we see a slight acceleration next year on the back of stronger domestic investment, in particular in the construction sector, but also stronger household expenditure, which I'll talk a little bit about in a couple of slides. Okay, so to start off the more detailed analytics, to first talk about our Nowcast of modified domestic demand. And for those of you who aren't familiar with the Nowcast, well, this is basically an in-time estimate that takes a lot of high-frequency indicators that measure various aspects of the Irish economy, from retail sales to consumer sentiment to some of the public finances indicators, and puts all of these together in a methodological framework that gives us an in-time estimate of where we see the growth trajectory for that modified domestic demand component. And you can see that the chart here provides both the actual outturn from the national accounts from the CSO in green, and then our model's prediction in dark blue. And you can see we do a really good job historically of predicting the outturn for economic activity measured by MDD. And two things are important to note. You can see that the expectation for the second quarter of this year, which we're currently in, is for continued growth, but some moderation. But actually for the first quarter of the year, the actual outturn was much higher than we had anticipated before. So you can see quite a strong growth rate coming into the year for consumption, and again for some of the modified investment components. Okay, so to just characterize the risks that we see, in our commentary for the past number of quarters, we've carried a risk register, which has tried to outline some of the key factors that we think are weighing on both the downside and the upside for the Irish economy. And we think it's a good way to characterize them to think about a breakdown between the external conditions, so the external risks that we face, and also some of the domestic specific risks that are more focused on what's happening within the Irish economy. In terms of the international conditions, I think two of the key risks that started the year were the banking sector challenges, which is both coming from the transition of the banking sector to this higher interest rate environment, and the likelihood that both the tightened credit conditions, from a volume perspective, but also the higher interest rates globally, how they may dampen investment and trade activities. Now, while some of the more acute banking distress appears to have waned internationally, those higher interest rates are still likely to weigh on investment and trade activities, because companies will be reappraising their cost of financing. I think an ongoing, long-standing risk really is the uncertainties around the conflict in Ukraine and its ongoing impact on a range of commodity markets, including both the energy and the food prices. And really, from a European perspective, we have seen quite a moderation in energy inflation, but the key element is going to be whether we come into that winter period next year, whether there are any re-acceleration of those components, or whether we can continue to maintain that level decline we've seen in some of the energy prices. And I think that'll be a key element. Further, broader element is the ongoing potential for geopolitical deglobalization or geopolitical fragmentation of trading linkages, and the uncertainties around long-term relationships, in particular between the US and China. Focusing more specific on the domestic side, I've mentioned these two big sectors, pharma and ICT, that are a major component of our exports and also major contributors to our corporation tax. And again, shocks to those sectors, carry significant risks, both from a number of different channels, both through the real economy and the employment sector, but also through the public finances and the export sector. One of the big risks that we'll be talking about a little bit more when we discuss the labour market is the potential for acceleration in the tight labour market, feeding through into wage bargaining, which potentially could feed through into wage-based price increases. And if that happens on a European-wide basis, this may prolong the high interest rate cycle, but on a domestic perspective in Ireland, this could also reinforce some of the inflationary pressures and change the composition of what's driving inflation. And again, I think focusing in on the labour market, one of the key elements that's problematic for the Irish economy at present is really we're operating at capacity. So the labour market is extremely tight, and that's creating capacity challenges in many key sectors, in particular construction. Okay, to talk a little bit about our outlook more specifically for investment, I've kind of characterized what the main factors that we see driving this. If we focus in on the top chart, what we've seen is a lot of volatility that's traditional with investment activities. But if you look at the grey line, which is the machinery and equipment, excluding the aircraft leasing, we saw a downturn towards the end of last year, but then a pickup again in the first quarter of this year. And then when we look at construction, we saw some pickup last year and a moderation into this year. And I'll talk a little bit more detail about that. What's kind of changing the trends, what's affecting the outlook for the investment. Obviously, these geopolitical factors that I mentioned, the global uncertainty, but you can see the bottom chart here is just quite a very quick and snapback nature of the interest rate rises that we've seen across all of the main central banks. You can see here the Federal Reserve funds rate, the Bank of England base rate, and the ECB policy rate all have snapped back last year, and that's likely to affect investment expenditure as the cost of financing changes firms' views on what are viable or non-viable investments. So looking at our forecast table, we are in very strong outturn for investment for various reasons, including multinationals last year. For this year, we are still expecting a degree of investment growth. For the overall investment, we're expecting 5%, just under 6% this year, just over 6% next year. And for the modified investment, we are expecting lower growths than those. In 23, we're expecting it to be just under 4% and 4.5% for 24. And in a sense, from the modified investment side, one of the reasons why we have that slower growth rate this year is we're expecting a drop down in the housing completions this year relative to last year, and then a somewhat acceleration into next year. So I think that's an important element to remember. To focus in a little bit more about the housing and the construction outlook, it was natural following the disruptions of the COVID-19 pandemic, which had a stop-start nature to construction activity, some of the supply chain bottlenecks and the very heavy cost pressures that were happening within the construction sector, that there was going to be an effect on the profile of completions. And what we saw was a slowdown in housing starts, so commencements in 2022. And we're passing that through as to reduction to an expected reduction in completions in 2023. So we're expecting around 27,000 units to be produced this year. More recently, in particular the last number of months, there's been a kind of re-acceleration in the commencements activity, and normally that passes through with the approximate 12-month forward lag, and we're expecting that to lead to a rise in housing completions into next year. You can see the chart here documents both the commencements in green and the construction materials inflation in blue, and while the rate of inflation is still high for construction materials, you can see there's been some deceleration in the rapid inflation in the past number of months that we've seen, and that is that's if that continues, that's likely to be able to be a supportive factor for the construction activity. In terms of house prices, one of the elements that we've documented in our kind of new thematic flow of material within the commentary is that the rising interest rates are likely to be putting down pressure on the housing market, and you can see that over the past number of months, the growth rate of house prices has decelerated quite rapidly. And when you adjust for inflation, you can see actually in real terms the rates the house prices are coming down. Okay, to just talk a little bit about consumption. So household spending is mainly driven by two factors. One, income growth, so how much nominal income growth is growing for households, what's happening with inflation, and then how much of that income are household savings. So they're the kind of three components that go into household spending. We saw savings grow massively through the pandemic for Irish households. That's actually remained high, more surprisingly high than we had previously anticipated. We had expected that to drop off, and nominal incomes are actually beginning to pick up. That combination of factors leads us to feel that there will be continued growth in household expenditure this year, so just under 5%, which is extremely high, and 5% next year. And that will be both affected by what we do see as a more balanced reduction in the savings ratio going forward, but also in an acceleration in wage growth, which should provide a supportive context for household spending for the period ahead. Obviously, one of the key elements that we've been documenting as a challenge for the economy over the period ahead has been the rising cost of living and the inflationary pressures, and this has been really the core element of the risk, in particular for low-income households. You can see the chart here on the top right-hand side documents the headline level of inflation for Ireland and for the euro area. And while inflation rates are remaining high, certainly since the last couple of months of 2022, there is a downward trend in the overall inflation rate. And however, when you strip out some of the energy-related activities and you look at the core inflation, you can see the chart on the bottom here, that is remaining stubbornly high. So while we are seeing a moderation, and that's occurring mainly due to the moderation in the energy inflation, the core inflation is remaining stubbornly high, both for Ireland and for the other European countries. And that is a real challenge, particularly the ECB are trying to use monetary policy to take demand out of the economy to try and pull inflation back, but this core level is remaining extremely high. If you look at the forecast table here, we provide forecasts for both CPI and the HICP, so two different measures of inflation. For CPI, we're expecting inflation to be approximately 5% this year, dropping to 3% next year, and then the HICP is just over 4% for next year, dropping to under 3% just over 4% for this year, dropping to just under 3% for next year. To think a little bit more about what's happening specifically, and in a number of commentaries we've tried to give analytical assessments of the distributional effects of price rises. So they affect different households differently depending on the resources. It's a key element. So we need to think about where the inflation is coming from. You can see on the left-hand side here, energy prices internationally have been coming down, and the inflation rates have been coming down for Ireland on a more sustained basis. And actually, if you look in the commentary, there is an analytical box by our colleagues in the energy team, which try and look at the pass-through between international markets and the retail prices that Irish households face to help us understand, whether this will continue. And certainly it appears as if there's going to be a moderation in the inflation from the energy side. However, from the food side, you can see this is an element that's been growing reasonably rapidly. For Ireland in green, it's continuing to grow rapidly, and this is an area that's maintaining its inflation rate at present, even though it's in the euro area, it's coming down. So still high levels of inflation. Composition is changing a little bit. Energy is coming down, but other things appear to be kicking up. As I mentioned, there is a box in the commentary which looks at the pass-through between what happens internationally and the domestic prices. And the expectation really is that in the next 6 to 12 months, there should be a moderation in the level of retail prices going forward, which should provide some alleviation for households on the price rises we've seen over the period ahead. Okay, with that, I'm going to just pass over to Kieran, who's going to talk through the rest of the material.
Thanks, Conor. Good morning, everybody. So, as Conor said there, one of the factors, I suppose, that we've encountered this time out has been a notice kind of easing of the export performance, which had been very strong in the overall economy over the past year. But we've definitely seen, I suppose, a slowdown in merchandise trade, in particular, over the past 6 to 9 months. And you can see that there in terms of the graph. We have the actual performance in terms of its year-on-year growth rates, and then we have just rolling averages, 12-month and 3-month, just to capture, if you like, the underlying dynamics as far as to how they're performing. And so particularly, I suppose, what's caught our eye, and I suppose what people have noticed recently, is the downturn in terms of export performance for chemicals and related products. Again, this goes back to this notion of the concentration of the economy, very heavily reliant on both the pharma and the ICT sectors. And so whenever we see a kind of a significant change in the performance of these sectors, it is something that we would note. And clearly, in terms of exports, you can see the decline in terms of annualized growth from January to April in chemicals and related products of 6%. Machinery and transport is also down minus 14%. This may again be related to the change in interest rate environment that Conor has talked about on a global basis. Obviously, the tightening of policy by monetary authorities in relation to the inflationary pressures and the heightened interest rate, it does have adverse effects as far as machinery and general kind of investment equipment is concerned. With the national accounts, it's always a little bit hard to determine whether this is a genuine reflection of underlying investment activity, or whether it's something that's just some if you like to do with multinational related transactions where they're simply moving stock around the place. So it may just be that, but nonetheless, it's something that we are obviously going to keep an eye on over the coming months and quarters. So if we move on to the next slide, in terms of our overall outlook for the growth for the export sector, we have moderated that down, as Conor said, to just 4% growth this year, 4.2% growth this year, and 5% next year. And in relation to that, we're also seeing an increase in import levels. So we are seeing an increase in imports with the exports moderating. So overall, then that has a negative, obviously, effect on our headline GDP figure. And we have revised that down this time out as well. In terms of the exports generally, we are seeing resilience in the ICT sector in Q1. So you are seeing kind of reasonably strong year-on-year growth there of over 8%. But we are seeing this contraction as far as pharma exports are concerned. And obviously, as I said, over the coming quarters, what will be important, it will be to see whether this is a general trend, reflecting maybe a deterioration in international global conditions, around the interest rate environment, for example. Also, you have seen some appreciation, for instance, in the euro against certain currencies, whether that's having a negative effect, or whether, again, this is purely just a kind of a one or two, to do with one or two or major transactions with a few small number of multinational firms. That's always the challenge, I suppose, in terms of determining whether this is a one-off or whether it's a part of a broader trend. In terms of the labor market, and again, this is where you have this dichotomy between the very strong domestic performance and then, you know, the kind of the weakening in some of the headline indicators. So we can see that the labor market is continuing to perform very, very strongly. We have unemployment down at 3.8%. We were initially, when we were looking at this, felt that the sub 4% rate was a historical low, but it actually had dipped before 4% sometime in the recent past. But clearly you are into relatively unprecedented waters as far as the unemployment rate and employment growth generally is concerned. We are seeing very high levels of job vacancies. And again, this is something which, you know, we encounter both ourselves as an organization trying to hire and also just anecdotally talking to employers. It's clear that it is a very, very tight labor market. That does give rise to accelerated wage pressures. We do see wages growing this year by around 5%, next year by 6%. So that is quite a pickup in wage-related costs. And obviously there is the issue of capacity constraints as far as the overall performance of the economy is concerned going forward. An interesting box by our colleagues looks at employment permits and developments in the labour market. So this is drawing off employment permit application data for non-EEA nationals, you know, which provides, looking at this data and trends in this data, provide a very useful indication of the demand for labour in certain parts of the economy. And so, for example, Emily and Wendy's work looks at how the surge in permit applications over the last 3 years. So we've seen those applications increase by nearly 90%. These, you know, the kind of sectors that can be targeted with these applications are you know, it does provide policymakers with a degree of flexibility and with a useful tool in terms of addressing capacity constraint issues. So, you know, they can designate certain sectors which they believe there are capacity constraints or capacity constraints may arise in, and use these applications then as a way of targeting the provision of greater labour in those sectors. And so clearly, we've seen permit applications in Q1 continuing to increase in sectors with shortages. So in healthcare, accommodation and food services, you know, clearly you're seeing a surge in applications in these areas. So from an analytical point of view, it's a very useful tool to look at this because it provides us with an indication of where there are real pressing needs in the domestic economy. And as I said, from a policy perspective, it is quite useful as it can help policymakers to kind of tailor measures, if you like, to try and stimulate increases in labour supply in certain key sectors of the economy. Another box in the economy, box in the commentary, looks at the labour market aspect of the Irish dual economy. So we focus quite a bit on the dual economy, looking at output indicators and productivity indicators. And obviously some of these are distorted by some of the multinational related transactions that occur. So what we do in this is just focus purely on the labour side. So just to look at the contribution that the dual economy or the issue around the dual economy as far as the labour market is concerned. So we look at a variety of different labour market indicators, and in particular, we look at labour market compensation per worker. This is all from the CSO data, which splits out obviously the domestic economy versus the multinational dominated sectors of the economy. And what's striking about it is, you know, obviously the particularly the faster growth in employment in foreign dominated sectors since 2015, and the significant difference which is emerging in wage levels between the two sectors. So if you look at those sectors that are dominated by domestic firms, you can see the extent to which labour income has increased over the past period of time, but you can see that it's outstripped by compensation levels in the sectors that are dominated by foreign firms. In general, I mean, it's a positive development that you have such strong income growth across the economy. Obviously, it does give rise to competitiveness pressures for domestic firms because they're clearly drawing off a lot of the same labour market base that multinational firms are. So if wages are really growing in the multinational sector of the economy, that does put upward pressure on wages in the domestic sector of the economy. So it does give rise to competitiveness pressures, particularly for domestic firms in the Irish economy. So if we just move on then to the public finances. Again, what we've seen through the start of the year has been the very, very strong performance in most of the main tax headings. So in terms of income, VAT, and obviously corporation tax. Now, what will be interesting to see as the year progresses, if we do have this kind of, if this downturn, if you like, or moderation in export performance by the pharma sector, if that kind of continues on an ongoing basis over the next couple of quarters, will that map into lower corporation tax receipts from the pharma sector? That's something which, only time will tell. But again, I do think it does serve to highlight, and the kind of the downturn in exports from the pharma sector does kind of highlight the point we've been making about the concentration issue in the domestic economy. And this is particularly relevant as far as the public finances are concerned. Obviously, at a headline level, the public finances are in very rude health. You can see our forecast for the GGB, the general government balance, at 1.9% this year, 2.9% next year. I mean, those are very, very strong figures, and you can see the resulting fall off in the debt to GDP ratio, which had been very high after the financial crisis, is now down to very low rates, or relatively low rates on a historical basis. But again, a lot of this goes back to the sustainability or otherwise of the corporation tax receipts that have been accruing over the last number of years. Obviously, we welcome, as we said before, the establishment of the National Reserve Fund, and we do think it's important that that is used, if you like, for the kind of less sustainable funds to be transferred to that fund, and obviously then a kind of a debate about what the appropriate use of that fund is. So then, just moving on to the assessment, the final slide. We had a piece of work presented by our colleague John Fitzgerald yesterday, which looked at trying to dig out again the underlying rate of growth in the Irish economy. John's work would suggest the economy grew by just under 4.5% on average between 2013 and 2021. I mean, that's when you take out most of the multinational related distortions. That is a very, very strong rate of growth for any economy, particularly on such a sustained period of time. If you took out some of the corporation tax receipts, that means that the growth rate would have fallen to 4.1%. But again, anything over 4% is a very, very strong growth rate on a sustained period of time. And we continue to see strong growth in MDD this year and next year. We do see this kind of some frailty as far as exports are concerned and the growth in imports. That does mean that our headline GDP figure is down quite a bit compared to the previous, but the underlying position of the economy, I think, is still very strong. And as I said, that's evidenced by the tax receipts and the labour market performance. Obviously, Conor's outlined the risks. Tightening monetary policy is certainly impacting the housing market. We are seeing a slowdown in house prices. However, that did reflect the fact that house prices grew very, very strongly last year and the year before, mainly because of pandemic-related effects. Housing supply continues to fall below the demand, and it's likely that we will be revising our structural demand estimates. We have colleagues who will be doing that work by the end of the year. Those estimates are probably set to increase. So the gap between supply and demand is probably going to be greater as a result of that. So you are still seeing a gap between supply and demand in the housing market, but you do have this countervailing effect of the higher interest rates, which is certainly cooling demand in the market overall. The National Reserve Fund, we do talk a little bit about that in the assessment. It may well be that some funds from that fund may need to be used to top up the National Development Plan going forward. Particularly given some of the demographic developments which we've seen over the last period of time, particularly revealed by the census. I think it's clear that the population levels are set to be higher, and net migration certainly is higher compared to the kind of assumptions that were possibly made when the National Development Plan was conceived.